Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. Before we get started, take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer. And let's welcome Dimitri Pargamonic, the man of the hour. How are you doing, D?
Good. How are you all?
Great. And today we're going to look at option straddles, right, in screening form?
Yep. I'm going to share my screen here. And once we get to the screen, let me know. Well, and what we'll do is cover a screener that looks for potential candidates for option straddles. So when we look at options, there are different types of strategies that we can screen for or look for opportunities for. In today's tutorial, we'll look at the option straddle. Now, to get there from the main page, you could hover over screeners up top on the main menu. And once you're on there, go to the right and you could see under volatility, there's straddles at the money. Click on that. And this will take you to the options straddle screener. Up top, you'll see you have a bunch of different filters to choose from. And then one sec, well, thanks, the load is slow here. Okay. And then at the bottom, you'll have this table with data and analytics. And you do have tabs here that show you different types of analytics that are relevant to this option straddle. And the option straddle, really quickly, is a strategy where you take looking at the either buying or selling simultaneously, the call and the put on the same strike that is near at the money. Okay, when we look at, for example, here, if we look at Apple, the Apple is trading at $2.15, $215.27. That was as of yesterday. The markets are closed right now. So the nearest at the money strike is over here, the 215. And that's because we don't have a strike that's exactly $215.27. So this particular screener looks at the closest strike to the at the money. Okay. Before we do a screen, let's first just quickly go from left to right to look at what the different data elements are. And then we'll go and look and do a screen to narrow down potential candidates. So from left to right, you can see this is the symbol. It's for Apple. If you click on this little info sheet, it'll give you more information on this symbol. So you could see here, gives you the name, gives you statistics. If you tab through, you can read more about the stock, click on the news. And this is convenient, so you don't have to leave the page to get some quick information what this symbol is, which stock it represents. I'm going to close this. So then we see the stock price change, and the market cap. These are all sorted by market cap, highs to lows. If you click on any of these columns, it will resort this table by that column. Over here, we have analytics on the straddle that you're analyzing. So this is the straddle details. Over here, you're looking at it from the sell side, the April 17th expiration 215 strike. Okay, because the straddle, you could analyze it from the sell side or the buy side. And the way this analyzes the straddle is you need to look at the straddle price and perform an analytical on that price. Well, when you're selling a straddle, you could get executed anywhere between, the bid and the offer. The bid, the displayed bid, is the price that you could get an immediate fill. So this analyzes it from the bid side. Okay. If you're buying it, of course, you could get execution anywhere between the bid and offer, but the offer is something that you could immediately get an execution. So it'll analyze it from the ask side. So you could see here, this is the same straddle, April 17, 215, but this is if you're selling it on a bid. This is if you're buying it on the offer, and then it performs an analysis on that price. Okay. Now, to perform an analysis, we need some kind of a benchmark. Well, if we're looking at a price, the price is representing the premium you're paying for the call and the put, or that you're receiving for selling the call and the put. So now you have this premium, and essentially what is the straddle is something. It's when you're looking at a straddle, let's say from the buy side, right? Then you're expecting the stock to move by a higher magnitude than what the straddle is priced at, or by a bigger, or have more volatility than the straddle is implying. Okay, so that's what you're trying to analyze. Well, is the straddle priced or is it attractively priced from the standpoint of buying it or selling it? That's what we're trying to first determine and narrow down. So here you could see that in theory, we came up with this benchmark that it's worth $13.99. To do that, we looked at the historical data and looked at how the stock behaved in similar situation. If we gave it the same days to expiration, with similar strike, based on the historical stock movements, what was the average price, right? So we have this average price or end value of the straddle. Now we have this benchmark to compare it to. So here in this case, it's $13.99. Okay, so you could see that the straddle, the bid and the offer, right, is a little bit lower than that $13.99. So from the buy side, it's a slight edge to that benchmark. So if you're buying it $13.70, and in theory, if the long-term average value is $13.99, well, you're buying it below that benchmark. And if you load, the data is all in here, so it shows you how it got to this benchmark. So in addition, we have this win rate. The win rate is saying, well, how frequently in our observations did the straddle end up above or below? So in this case, if you're buying it, it'd have to be above 1370. Did it move enough percentage-wise to cover the cost of that straddle and be above it? That happened 35.5% of the time. Okay, so what that means is that even though the win rate, right, it's less than half, 50%, but the times that it paid off, it could have been so big that it pulled the averages up. Here we just moving along. This is defining the straddle. This is which ones you're analyzing, April 17 to 15 strike, and then we have this at the money volatility. So this is the implied volatility of the options. And this is the implied move, how much the stock has to move to cover the cost of that straddle, right? So 6.3%. And down here, we also list some potential catalysts that could make the stock move. So, for example, if we slide down here in TSM, that C represents a company event. So this is specific to TMC. So you could see that they have monthly sales coming out of April 10th. Well, April 10th is before this April 17th expiration. So that means that there will be some event prior to expiration that's specific to the stock that could potentially, cause the stock to move more, because in this event, we don't know what the outcome is or what the company will say. But it is some event that is specific to the stock where traders, investors are paying attention, and potentially could be a catalyst for a reprice. The M, that stands for general market events that could potentially, be material and move either the entire market or sector, that could be relevant. So we just listed here, like we could see here, the Federal Reserve FOMC meeting, then other economic indicators that might not be specific to this stock, like existing home sales, PMI manufacturing, GDP report, employment situation, but it could impact the markets, somewhat, and something to just be aware of, because some of these just happen to, if something unexpected happens or they're outside the expected range, there could be a repricing in the market as a whole, which could impact, any stock that has sensitivity to the market. Okay, so those when you hover over it, those are the things that that you could see. Now, we could, if we look at these tabs, right? Let's just go through the tabs really quickly on the events. The events here show you it's the same symbol, and here some of the important events are dividends. So you could see here May 9th. This one already, this is a dividend, but this will be after April, right? But this and next earnings, and these are events that are material to option pricing that you should know about. So a dividend is material to an option price because it's part of the option pricing model, right? Part of the option pricing model is the cost of carry and the dividends. So you should know if there's an expected dividend coming up. And earnings are also, material, because when you have an earnings event, there's an earnings announcement, and on that earnings announcement, the stocks reprice. There's more volatility, more uncertainty. Those are material to the implied volatility of the options. So over here on these events, so you don't have to leave the screener. You can just go to the tab and look at it. Okay. This historical distribution tab, this is a breakdown of the performance of the stock or stock behavior historically given similar situations. So here we see if we're analyzing the straddle details, April 17th to 15th strike. Well, we have this at the money implied volatility. This is the bid and offer in the straddle. This is the implied move, 6.3%. So for this particular straddle, there's 21 trading days until this expires. Historically, the stock on average moved 6.5% in either direction over a 21-day period. So now we could compare it to the 6.3%. We could see that historically, on average, it moved a little bit higher, 6.5%. And this is based on 31 observations, historical observations. So you're going back 21 days, then another 21 days, then another, and looking at the returns, right? This is a return distribution over 21 days. And we could see that the median move, half the observations were above 5.4%, half below 5.4%. So the median move is below the 6.3. Okay, so the average is getting pulled up. This times the average is getting pulled up because maybe some outliers. So what is the range of the moves? The range of the moves is saying, well, what is the lowest in our data, in our historical observations that it moved, and the highest? So we want to see that range. So the highest move was 15.7%. The lowest move was 0.2%. So barely moved. So it could happen where, the stock can move around, but after 21 days, kind of go back to where it was at the start. We've seen this move as much as 15.7%. So it gives us a good, analysis of the historical movements. So we could compare that to today's markets. Right, so now we can compare the 6.3, and where does that 6.3 look like inside those historical ranges and averages? Okay, so that's the idea here, and this we could just quickly visualize. What about from volatility? So that's looking at historical moves. We could trade the straddle based on the volatility. You would trade the Black-Scholes model, and then you would have to manage your deltas, rehedging, be delta neutral. So that would require us to look at the volatility of the stock. So we'll go here on the volatility, and now we could compare the current volatility, 27.4, versus historical volatility. So when we look at historical volatility, we have to measure it. We'd have to define how are we measuring this. So you'd have to look at, am I looking at 20 days of data, 100 days of data, longer? Because to calculate the volatility, we're looking, log returns of stock movements over some period. So the two kind of, standard ways, or maybe not, there's, everybody could do it differently, but typically what I see referenced is a 20-day volatility. So what did it do in the last 20 days, which is like a month worth of trading days. This allows you to kind of see the most recent history. How did the stock move compared to what the market is anticipating going forward? So in the last 20 days, the volatility was 27.6. So you could see that the market's 27.4 is very close to what the most recent history is. The markets are implying that the next, going forward between now and April 17th, the volatility will look similar to what we've seen in the last 20 days. Okay, so that's very close over here. What about the longer term volatility? So if we smoothed it out and said that the volatility tends to mean revert to the longer term average. So let's use a year, right? For the longer term, a year. You could go back further, but 1 year for the longer term is also typically used because if you go back too far, some of that data may not be relevant anymore. So for the 1 year, we see in the last year, Apple moved at a 23.6 volatility. That implies that the current implied vol, right, 27.4 versus 23.6 is trading 21% above its 1 year benchmark. So here it's trading close to its 20-day benchmark, but above its 1 year longer term. So the markets are implying that the next, the volatility going forward between now and April 17th will trade at a higher volatility than its 1 year historical benchmark. Okay, the 1 year historical, it would imply this straddle implies a move of 5.2% in either direction. So this would be, a comparison about it's indicating that a 1% differential, right? It will move an extra 1% above that historical benchmark. And this next tab is the risk. And what this is showing is that if what is your break even to the downside and upside. So if you're doing the straddle 25-27 and you're doing the straddle at $13.55, if you sell it, well, where's your break even points? So that's the range 201.72 228.82. If you sell it, you want the price to be within that range. Really, you don't want any movement. You want it to go right to 215, right? And both options to expire worthless. But this tells you what is the range of profitability. So it has to be within there if you're selling it. Right? That's your break even. If you're buying it, 1370, well, you want it to go above this or below that. Okay, so that's the idea between the break evens, and the reason is because you're doing it at different prices here. We're analyzing this from the bid side. We're analyzing this from the ask side. So one more thing with straddles is how do we calculate our potential return on a straddle if you're selling it. So this is a little bit tricky here. We could calculate our potential return if you're buying something because you know how much you have at risk. So when you're calculating your potential return, if I risk $1, to make to potentially, for something I think will be worth on average $1.20. So you're risking $1 to make 20% return, right? It's because you know what you're risking. When you're selling a straddle, it's not defined what your risk is because the straddle, the stock could move to any point, and theoretically, you have an unlimited amount that the stock could move up, right? You're selling a call, you're selling a put, but you don't know how far away the stock could move. So, okay, I sold the straddle for $13.55, but what is my risk? I'm potentially could make $13.55, but what is my risk is the question. Because if can the straddle be worth $20? Could it be worth $50? Can it be worth $100. So I don't know what my potential risk is just from looking at it. I have to estimate it. Okay, that's the thing, that here the risk is not defined when you're selling an option, because you have an obligation to deliver the stop, and it's not defined. There's an unlimited risk potential there, but we need to estimate it somehow based on something, that we could shock the stock and say, okay, well, if I shock the stock, what am I? How much amount do I have at risk? So when you're buying it, your amount at risk is what you paid. That's what you could lose. You could lose what you paid, $13.70. When you're selling it, we're not sure. So to give it an estimate, because we want to know, okay, how much, potentially can I lose, and based on that, what can I potentially make? You want to know your risk reward. We want to shop the stock based on some historical, outliers. We could do averages, but let's look at historical outliers. So here we have 3 ways to shop the stock. One is, let's say any stock could experience a 10% move. So we need to give it at least that, even if the implied volatility doesn't suggest it. We'll say at least a 10% move as a shock. Then we'll say, what about a 3 standard deviation move? All right, so let's take a standard deviation and let's shock it 3 standard deviations in either direction. And how much would I potentially lose? So here you could see that would result in an $88 loss. You would have to buy back whatever you sold it for. You'd have to buy back at an $88 loss. In addition, what if we just looked at the historical max move in this time period? That would result in a $54 loss. Okay, so even though you sold at $13.55, you'd have to buy it back at a price where it would, it would result in a $54 loss to you. So now we're shocking it to get an idea what's our potential risk. If you're selling something, what's your potential risk? So these are like the on 3 extreme shocks we gave it, and we'll take the highest one, to try to get the the risk reward ratio here. So that's one thing you have to try to estimate when you're selling options. What's my potential risk? Especially when you're selling an option where you don't spread it or have something, a different option to stop you out. So this here gives us the risk, what you're risking, the amount at risk, over the amount you could potentially make, $13.55. So you could see you're risking, if a 10% move happens, well, you're risking, losing twice as much as you stand to make if nothing happens. If you make $13.55, nothing happens, like it just sits here. But if it does move 10%, you're risking losing twice as much as you would make. If the stock moves 3 standard deviations, you're risking losing 6.5 times more than potentially you could make. If the stock moves at the biggest, the biggest move it has done in whatever 21 days, then you're risking losing 4 times as much as you potentially make. So these are the extreme shocks. So you could, you're aware of them before you even get into a strategy. You want to, try to see those risk potentials. So, well, we went over the data elements. I didn't get to the screen today. Maybe we'll do the screen, but I wanted to kind of go over each analytics. So you understand that first.
Yes. So tomorrow we'll look at actually doing a screen. So
Yep.
we'll do a part 2 webinar tomorrow. Thanks everyone for joining us. Thanks for this webinar, D. Super helpful to the Chameleon community. Everyone have a great, safe trading day. Thanks, D.
Thanks, everyone. Have a good trading day, and hope to see you tomorrow.
Trade in peace, Chameleons. Have a great day. Bye-bye.